As investors, we're constantly sifting through countless options, aren't we? Always searching for that elusive best investment, especially in the ETF space. Even tiny advantages, they can compound dramatically over the years.
Absolutely. It's a crowded field.
It really is. So today we're going to dive deep into one specific option, the Schwab Fundamental U.S. Large ETF, or FNDX.
FNDX.
Our mission, to really unpack FNDX's unique approach, understand its performance claims, and figure out, well, for whom the specific fund might actually be an incredibly smart choice.
Good plan.
We're going to try and cut through the noise using the sources you've provided and get right to those core actionable insights. So where should we begin to unpack this?
Well, I think that mission is crucial because it hits on a really fundamental challenge for investors.
Just is.
It's that balancing act, isn't it? How do you effectively balance pursuing income, dividends, with the overall portfolio performance you get from capital appreciation?
Right. They often seem like separate goals.
Exactly. Many investors often assume these goals are always separate, maybe even at odds. But FNDX, it really challenges that assumption.
That's so.
What's fascinating here is how it aims to do both. And, often, quite successfully, it's trying to bridge that gap.
Okay, that's a crucial point to establish right up front. Now, when we look at FNDX in the, let's say, the broader ETF landscape, it's important to note it's not the biggest fish in the pond, dividend-wise.
Not by a long shot, no.
It's got about $18 billion in assets. Now, that sounds like a lot, but then you compare it to the giants.
Yeah.
You've got VIG, the Vanguard Dividend Appreciation ETF. That's around $91 billion.
Huge.
And then there's SCHD, the Schwab U.S. Dividend Equities ETF, with $68 billion.
Oh.
So yeah, FNDX is markedly smaller.
And this is precisely where we can maybe challenge a common perception. It's easy to get fixated on asset size, bigger is better.
Sure, that's the usual thinking.
But FNDX's relatively smaller footprint is actually, it's integral to its distinct strategy. It's not trying to compete on sheer size. It's not just another pure dividend fund like VIG or SCHD.
So it's got a different game plan.
Exactly. Think of it more as a performance-oriented value fund that also happens to make regular and reliably rising dividend payments. Its size, maybe, allows it to be a bit more agile in its specific approach.
Okay, so it's really about looking beyond just the dividend fund label then? If its distinction isn't only about dividends, what's its unique engine? What makes it tick?
Right.
Its underlying index, the RAFI Fundamental High Liquidity U.S. Large Index, quite a mouthful.
Oh, it is?
Let's call it the RAFI Fundamental Index for short. It's definitely not on most investors' radars. So what makes this index's premise so interesting?
Okay, yeah, this is where it gets really interesting. Unlike, say, the S&P 500, which is market cap weighted.
The standard approach.
Right, the standard, it just lets holdings kind of ebb and flow until replacements are needed. The RAFI Fundamental Index takes a, fundamentally different approach.
How different?
It weights its holdings based on fundamental criteria. Things like equity versus assets, operating cash flow, and even a combination of dividends and stock buybacks.
Okay, so not just the stock price.
Not just market perception. These are metrics looking at a company's underlying financial strength and health.
Yeah.
Equity versus assets tells you how much shareholders truly own versus debt. Operating cash flow shows the actual cash the business generates.
Real substance.
Exactly. They're robust measures of a company's true economic footprint, not just its current market price. The core idea is pretty simple, really. The more fundamentally compelling a stock is based on these metrics, the more of it the index owns.
And it rebalances quarterly, not annually like many others. Some might immediately see that quick cadence as a drawback, maybe higher turnover, more taxes. Is that the case?
That's a common concern, but according to the fund itself, this quick cadence of quarterly rebalancing isn't a drawback at all. It's actually presented as a key feature.
A feature? How?
Well, the thinking is the strategy of regularly and proactively swapping out potentially overvalued value names with more undervalued ones. It actually eliminates the performance drag associated with traditional passive investment vehicles.
Ah, that drag you mentioned, holding on to stocks that have run up too much.
Precisely. That inertia. FNDX's quicker rebalancing aims to sidestep that, and they make a pretty bold claim about it.
Which is?
They claim this approach has historically led to outperformance in developed markets of approximately 1.5%, 2% annually.
Wow, okay. 1.5% to 2% annually. That's significant. But, claims are one thing. Does the data, the actual long-term net gains for FNDX, does it back that up?
Well, this is where, the proof is in the pudding, so to speak. And the data is interesting. When you look at its performance over the past 10 years,
Yeah.
FNDX has actually outperformed both the comparable Vanguard Value ETF, VTV, and the Schwab U.S. Large Cap Value ETF, SCHV.
Really? Outperformed both VTV and SCHV.
Over that 10-year period, yes. So it seems this slightly more, let's call it active, but automated replacement strategy. Well, it seems to work at least a little better than a pure buy and hold minimalist approach for this kind of value tolt.
Okay, that's compelling on the capital appreciation side, but let's pivot back to dividends. For many income investors, that immediate dividend is paramount. So where does FNDX actually land on that front? Does it deliver income?
Right, the yield question. Well, its current trailing yield is a mere 1.8%.
Only 1.8%. That sounds quite low compared to others.
It is lower than, say, SCHD, which is just under 4%, or NOBL, the Dividend Aristocrats ETF, which is nearly 2.5%.
So much lower starting yield.
Much lower. However, this is where the nuance truly matters, and it's where FNDX challenges that common assumption we talked about.
Which assumption?
That investors should prioritize the highest starting dividend yield, sometimes at the expense of total return. That 1.8% yield from FNDX, it's based on payments that have been reliably raised since the fund started back in 2013.
Ah, so the growth is key.
Exactly. In fact, its quarterly per-share payout has more than doubled over the course of the past 10 years.
Doubled in 10 years. Okay.
So while it offers a smaller starting yield, its dividend payment grows just as quickly, sometimes even faster, than those of more obviously dividend-minded ETFs.
Interesting trade-off. Lower start, faster growth.
And here's the real insight, the sort of aha moment maybe.
Yeah.
On a net basis, considering the reinvestment of both capital gains and those growing dividends, FNDX has actually outperformed both NOBL and SCHD since mid-2015.
Outperformed NOBL and SCHD on a total return basis since 2015.
Yes, by virtue of its greater capital appreciation, even if it hasn't led for the entire 10-year stretch against every metric. So a modest but rapidly growing dividend, combined with that unique capital appreciation strategy, it can lead to superior net wealth creation over time.
That really changes the perspective, doesn't it? It's not just about the starting yield number.
Not at all. It's the total picture.
Okay, so we've looked at its unique strategy, its performance on both capital gains and dividend growth. The big question then, for you, the listener, is this ETF the best or not?
Well, as is almost always the case in investing, it absolutely depends. It depends on your specific goals.
So let's break that down. Scenario 1.
Okay, scenario 1. If you are laser-focused on getting the highest possible entry yield right now with an investment that will also reliably grow its dividends over time, then yeah, NOBL or SCHD are probably your best options.
There's a trade-off.
Absolutely.
Yeah.
Understand the trade-off. You'll likely see weaker net gains overall, mainly due to potentially weaker capital appreciation compared to FNDX's strategy.
Okay, makes sense. And scenario 2.
Scenario 2. If you're looking for more of an equal combination dividends, dividend growth, and a simple way to add value holdings to your portfolio, maybe especially now when growth stocks might be losing some steam.
All right, portfolio balance.
Exactly. Then FNDX makes good sense. Despite its more modest initial yield, it offers that blend.
And for the right investor profile, that nuanced approach sounds incredibly powerful. But let's talk practicality for a second. What about that turnover? You mentioned it rebalances quarterly. The portfolio's turnover is above average, over 10%.
It is.
That usually leads to greater annual taxability, doesn't it? Is that something folks need to seriously consider if they're holding this outside of an IRA or a tax-sheltered account?
It's definitely something to be aware of, yes.
Yeah.
That higher turnover can create taxable events more frequently than a very low turnover index fund.
So potentially a bigger tax bill each year?
Potentially.
Yeah.
FNDX's higher turnover and potential for annual taxability might seem like a straightforward drawback. But here's an insight that often gets overlooked, especially for long-term holdings in taxable accounts.
Okay.
This consistent realization of smaller gains effectively resets or raises your cost basis incrementally each year.
So you're paying tax along the way, but it reduces the big hit later.
Precisely. The portion of your investment considered profit for tax purposes is reduced with each annual realized gain. That can make a future sale, maybe years down the line, less daunting from a tax perspective.
Even for someone in a very high tax bracket, does that logic still hold?
Well, for someone in a very high tax bracket, the annual tax bill might feel more acute, sure, but the core principle still applies. You're recognizing gains incrementally, rather than facing one potentially huge concentrated tax event decades later when you sell.
So it's managing the timing.
It's often about managing the timing and, smoothing out those tax liabilities rather than just kicking the can down the road indefinitely. Look, you'll owe taxes one way or another eventually on gains. This approach just makes it more gradual and potentially more palatable.
That's a really interesting perspective on the tax implications. So it seems best truly is subjective, isn't it? It has to be tailored to individual goals, risk tolerance, and even tax situations. FNDX certainly carves out a compelling niche, offering this blend of value, capital appreciation, and that growing dividend stream for a particular kind of investor. Thinking about everything we've discussed, what's maybe one common pitfall investors fall into when they're trying to find their best fit, and how does this FNDX story help us avoid it?
That's a great question. I think a really common pitfall is getting too fixated on a single headline number.
Yeah.
You know,
Like the highest yield.
exactly. Or maybe the most impressive short-term capital gain number or the lowest expense ratio in isolation. FNDX's story, I think, helps us avoid this because it demonstrates that the true power often lies in a specific, well-executed strategy that combines different elements. The goal is superior net wealth creation over the long haul, not just winning on one metric.
So look beyond the headlines.
Look beyond the headlines. It prompts us to ask ourselves, how do you balance the pursuit of high current income with long-term capital appreciation in your own strategy? And maybe even what unique, often overlooked features like FNDX's rebalancing or fundamental weighting do other funds you might be considering have. Features that aren't immediately obvious from those top-line numbers.
Right.
Understanding these nuanced details, just like we've tried to do with FNDS today, can really enhance your financial knowledge and hopefully improve your outcomes.
A fantastic thought to end on. Really dig into the how and why behind the numbers. Thank you for joining us for this in-depth exploration.